The Datavault AI Inc. stock, trading under the ticker DVLT, is currently at $1.60 per share, reflecting a significant intraday drop of 8.46% as of 10:50 a.m. Eastern Time on this Wednesday, November 19, 2025. That steep decline, over 8 percentage points, immediately catches your eye, especially when the news flow around this company has been overwhelmingly positive just in the last 48 hours. The market's expectation, fueled by a stunning Q3 report and jaw-dropping guidance, was that DVLT would be surging or at the very least consolidating near its recent highs. The reality, however, is a sharp and somewhat counterintuitive pullback. This is the first essential piece of unexpected insight. The stock is actively selling off, despite management just raising their 2026 revenue guidance from $50 million to an aggressive, almost unbelievable $200 million minimum target. That kind of upward revision, a 300% hike to future expectations, typically sends a stock through the roof. Yet here we are, watching the price dip. The tension between this phenomenal corporate forecast and the bearish intraday price action is the central puzzle we need to solve to understand where DVLT is truly headed. The general belief among the new wave of speculators and momentum traders who've discovered Datavault AI Inc. is that this is the classic hidden gem in the AI and Web 3.0 space, an overlooked microcap that's about to make a parabolic move thanks to its focus on real-world asset or RWA tokenization. They see the headline figures, $2.9 million in Q3 revenue, a 148% year-over-year increase, and that massive aforementioned $200 million 2026 revenue target. They are viewing this through the same lens that drove the early excitement around NVIDIA stock, looking for the next infrastructure play that sits at the convergence of multiple high-growth technologies. This community, likely trading on platforms like Robinhood and looking for high-risk, high-reward plays they can self-invest in, is buying into the story of an exchange of exchanges, a platform for tokenizing everything from gold and geothermal assets to genomic data and comedy scripts. However, the deeper reality is that this stock's current volatility is a direct collision between this ambitious, forward-looking narrative and the harsh realities of execution, market skepticism, and significant shareholder dilution. The stock has been a roller coaster, up nearly 300% over the last 90 days, but still down sharply over the last year, showing the long-term caution. The reason for today's drop, despite the positive Q3 report released just 2 days ago, can be traced to a few key areas. Firstly, the actual Q3 revenue of $2.9 million, while representing strong growth, technically missed the consensus analyst estimate, which was floating around $6 million. This is a common phenomenon in highly volatile emerging growth companies. Expectations get ahead of the actual results. Even as the company raised future guidance dramatically, the fact that they missed on the current quarter's revenue print created an immediate sell-the-news event. Secondly, you have to consider the scale and ambition of the $200 million guidance. It's an incredible target, primarily fueled by the potential of its licensing model monetization and the pipeline of RWA tokenization deals, including a $10 million worldwide licensing agreement with Scilex and a multi-million-dollar RWA services agreement with Triton Geothermal. The market is divided on whether this is an aggressive but achievable goal based on signed contracts, or if it represents an overly optimistic projection for a company that generated less than $3 million in the most recent quarter. This kind of enormous expectation setting naturally attracts short sellers, who may see the current volatility and the gap between current revenue and future guidance as a prime opportunity. High short interest, which has been notable for this stock, tends to amplify downward pressure on days when retail euphoria gives way to institutional skepticism. You can easily imagine an Interactive Brokers trading account seeing this move and initiating a short position, viewing the recent run-up as a speculative bubble rather than a fundamental re-rating. The high volume of trading, already exceeding 12 million shares this morning, confirms this tension. It's a battleground. For an individual brokerage investor, the appeal lies in the potential connection to massive secular growth themes, the maturation of AI, the financialization of all assets via tokenization, and the increasing need for verifiable digital credentials in a Web 3.0 environment. The company's business model is fundamentally split into two divisions: the data science division, which focuses on its patented platforms for secure data valuation, exchange, and AI-driven monetization, and the acoustic science division, which includes its WISA and ADIO technologies for high-definition wireless audio. While the acoustic division provides a tangible, existing revenue stream, the significant future guidance is almost entirely predicated on the data science side and the successful execution of its platform of platforms approach to creating vertical-specific digital exchanges, like the International Elements Exchange and a coming American political exchange. Now, let's reflect on the corporate fundamentals that support this dizzying outlook. Datavault AI Inc. has been around in various forms since 2010, previously known as WISA Technologies Inc. It changed its name in February 2025 to align with its shift towards AI and data monetization, a clear attempt to capture the zeitgeist. This history as a smaller tech company now executing a major pivot is a risk factor. The core value proposition today is its patented technology, which includes over 70 patents related to AI-driven data valuation, inaudible audio signaling, and blockchain tokenization. They aim to be the foundational infrastructure partner for turning real-world assets, the physical objects and data streams that lack verifiable digital value, into tradable, monetized digital assets. They're essentially selling trust and liquidity in a new digital asset class. The most compelling recent developments are the strategic partnerships. The exclusive $10 million licensing agreement with Scilex to monetize genomic and therapeutic data is a validation of the platform's utility in a highly regulated, high-value industry like biotech. Furthermore, the Triton Geothermal Agreement, with up to $8 million in upfront fees and a 5% participation in transaction fees from an estimated $125 million RWA offering, establishes a repeatable service plus participation model. This model is crucial because it implies future recurring revenue streams tied to the growth of the tokenized asset class itself. This is the bullish argument. They're not just selling software, they're taking a piece of the transaction volume on entire new markets they are helping to create. This is the kind of leverage that can justify ambitious forecasts, and why institutional investors like Vanguard Group, JP Morgan Chase & Company, and Geode Capital Management significantly increased their holdings in Q3 2025, according to institutional activity reports. These are sophisticated players who do not casually allocate capital into speculative microcaps, suggesting a belief that management's execution is legitimate. However, the cautionary flags are equally bright. The recent stock price turbulence is a warning. The reliance on forward-looking statements, that $200 million target is a massive number built on a lot of if-then scenarios, introduces high execution risk. Can a company of this size with its current operational capacity successfully execute on dozens of contract negotiations worldwide for tokenizing multi-trillion-dollar assets like gold, carbon credits, and diamonds? The move to a new Philadelphia headquarters is a sign of scaling, but the pressure to deliver is enormous. If a few of these marquee RWA deals are delayed, or if the regulatory environment for tokenization, which is still highly uncertain globally, shifts unfavorably, that revenue guidance could collapse, and the stock price would follow suit. The market for tokens and digital assets is still nascent and notoriously prone to boom and bust cycles, and DVLT's fortunes are intrinsically tied to its maturation. Furthermore, we must address the capital structure. While management highlighted a strategic $150 million investment agreement with Scilex that provides financial flexibility and minimizes the need for immediate cash raises, the stock has also seen insider selling in the last 6 months, a dynamic that can erode investor confidence, especially on platforms geared towards online investing. When the CEO and other executives are selling shares, it creates a psychological headwind for individual brokerage accounts and self-investing accounts trying to hold on to the bullish narrative. You have to ask yourself, if the 2026 forecast is genuinely $200 million, why would key insiders liquidate even a portion of their holdings? It's a classic expectation versus reality mismatch. Looking ahead, the key catalyst for Datavault AI Inc. will be the tangible progress on its RWA exchanges. The successful launch and demonstrable volume on the International Elements Exchange and the proposed political exchange will be non-negotiable proof points. The long-term upside hinges on a phenomenon that is still theoretical for most companies: recurring, high-margin revenue from transaction fees on digital assets. This is where the company aims to become a true infrastructure play, akin to what Interactive Brokers trading platform